All right, let's talk about a real estate investment that, on the surface, sounds, well, a little bit impossible. It's called the Signature Residency REIT, and it's an opportunity to invest in a project that is already 100% sold out. So how on earth does that work? Let's get into it.
It's a bit of a head-scratcher, isn't it? I mean, how can you buy a piece of the pie when all the slices are already spoken for? That's the puzzle we're going to solve today. And the answer, well, it pulls back the curtain on a really interesting corner of the real estate world. Okay, so to get our heads around this, we first need to understand a really simple but crucial idea. Not all real estate investments are built the same. You can basically boil most of them down to one of two models. Just think of them as two different kinds of shops.
So on one side, you've got what we can call the rental shop. A perfect example of this is the Dolmen City REIT. Its whole game is to build something amazing, rent it out, and then collect that steady stream of rental income. Success here is all about keeping the place full and rents ticking upwards. But then you have the sales shop. This model isn't about the long game of rentals. Nope. Its entire purpose is to build, sell the units off, and make a profit from those sales. And this, right here, is the key. The Signature Residency REIT is a sales shop, through and through. It's what's known as a developmental REIT, so it doesn't care about collecting rent for the next 20 years. It has a very clear, very simple mission. Build the project, get the money from the people who've already bought the apartments, and deliver the keys. Build, sell, deliver. That's it.
So, now that we know what type of shop we're walking into, let's go inside and see what's actually on the shelves. What is this project all about?
And there you have it. This is the Signature Residency project, located in Naya Nazimabad, Karachi. And as you can see, this isn't just some architect's dream on a computer screen. No, this thing is real, it's a high-rise, and it's already going up. This is the actual physical building at the heart of this whole investment. All right, let's get into the nitty-gritty. We're talking about a 21-floor building with 105 apartments. The offer price for you, the investor, is going to be 14 Pakistani rupees per unit. And you can get in on this during the subscription period in January 2026. These are the basic vitals, for sure, but the most important detail, the real game changer, it's not even on this slide. Okay, now we're getting to the main event. This is the secret sauce, the single most powerful feature of this entire deal. It's what answers our first question and what makes this project so different from almost anything else out there. 100%. That's the magic number. According to all the official documents, every single one of those 105 apartments, plus all the retail space, has already been sold. This isn't wishful thinking or some optimistic forecast. We're talking about signed contracts and locked-in buyers. So why is this such a huge deal for an investor? Well, think about it. The single biggest risk for any developer, the fear of not being able to sell their inventory, is just gone. It's completely off the table. In a market like Karachi's, sales can be unpredictable. This removes that massive what if. It means the total money coming in isn't a guess anymore. It's a known number. That gives you an incredible amount of clarity on the whole financial picture. Now, clarity is great, but we're all here for the numbers, right? So let's talk money. Let's break this whole thing down into a really simple in and out equation. First up, what's it going to cost you to get in the door? As we saw, it's 14 Pakistani rupees for every unit you buy. That's your ticket price, your initial investment to get a piece of the action.
And what do they project you'll get on the way out? Just over 20 rupees. So the basic proposition couldn't be simpler. You put in 14 and you get back 20.06. Sounds pretty good. But how exactly do you get that money into your hands? It's a two-part payout. Think of it like this. Part one is your profit. Once the building is finished and all the buyers have paid up, the profits are paid out to you as a dividend. That's projected to be 10.06 rupees per unit. Then, part two is you getting your original investment back. When the whole scheme wraps up and closes down, you get 10 rupees per unit. You add those two together, and that's how you get to your total of 20.06. This quote from the research report just hits the nail on the head. PKR 14 in, PKR 20 out. That part sounds great, but it's that last bit, but timing is everything. That's the pivot. That's where this whole story gets really interesting. So let's be real for a second. We've taken that huge sales risk off the board, which is fantastic, but that doesn't mean this is a completely risk-free, guaranteed home run. Now we have to talk about the one big variable that's left: time. Every smart investor has to ask this question. What's the catch? what could go wrong here and slow down that nice-looking return we just talked about?
And here's the thing. The main risks aren't about if you'll get paid, but when you'll get paid. Maybe the apartment buyers are a bit slow with their final payments, or maybe construction hits a snag and the handover gets pushed back. And if that happens, the final payout to you, the investor, gets delayed too. See the pattern here? Delay, delay, delay. It all comes back to the timeline. And this timeline really lays it all out. You put your money in at the beginning of 2026. Then you wait. The first payout, that big profit dividend, isn't expected until about a year and a half later, around the middle of 2027. And your original capital comes back even later. So you see, all the good stuff, all the cash flow is loaded at the back end. You got to be patient with this one.
And this is where that timing thing really hits your wallet. The issuer is projecting a very attractive annualized return, or IRR, of over 25%. Think of IRR as the annual growth rate of your money. But then, an independent analysis from Chase Securities takes a closer look. After they account for taxes and the possibility of some of those delays we just talked about, they figure the real-world after-tax IRR is probably closer to 16 to 18%. Now, that's still a solid return, but that difference shows you just how much your profit depends on everything happening on schedule.
So that's what it all comes down to, really. It's a classic trade-off. On one side, you have this incredible, almost unheard of security of a project where the sales risk is zero. It's a done deal. But on the other side, your actual return, the number that matters, is a moving target that depends completely on construction and payment schedules. So the big question you have to ask yourself is this: is that certainty at the start worth the potential wait at the end? That's the key question you've got to consider.